Hello, welcome. I'm Craig Fulton. I'm an advisor at Evergreen. And what I do here is make sure that MSPs get the most value of their business while they're going through M&A. And I'm excited to be joined with.
Hi, I'm Alex. I sit on the M&A team at Evergreen and specifically focus on acquiring new businesses in the MSP and IT services sector. So I've spent a lot of time talking to owners there and excited to be talking with Craig today.
Yeah, it's great to have you. And you touch on a topic quite often. I've seen you do it while we're out at events and on calls. And you look at the world in this big macroeconomic view, right? You're looking at what's going on with inflation and conditions. And I know a lot of MSP owners and business owners that see that and they know what's going on, but they may not tie some of the most important things down to what they do. And this is where you come in, Alex. So let's talk about the macroeconomic impact on business.
Yeah,
Take it away,
absolutely, Craig.
man. Yeah.
Yeah. I think it's a really hot topic always, and there's a lot of buzzwords that get thrown around when it comes to the macroeconomy, but being able to actually distill what that means for business owners and what that means for M&A and in the MSP world is really important. So maybe just looking at this slide here and thinking about some of the trends that we're seeing today and over the last couple of years.
Yeah.
You know, First and foremost, I think inflation's on everybody's mind. We all feel it in our everyday life, see it when we go to the grocery store, but it's also really important when we think about how it impacts the macroeconomy. So generally coming out of a downturn, and like one that we saw with COVID over the last few years, there's a period of inflation. And what that is driven by is that coming out of a downturn, there's usually a surge in demand, but supply lags demand in the macroeconomy. So
Yeah.
when demand goes up and supply doesn't come up as quick, that increases prices. And that's what inflation is. And that's economics 101. There's a bunch of other things that go into it, but generally most economists will agree that's what we're seeing. And how do we fight that? Because we don't want there to be sustained periods of inflation. So
Right.
raising interest rates is one of the ways that the Fed is able to try and pull back that demand to a more reasonable level and thus lower the prices. And we see that in a couple of different ways. Raising the risk-free interest rate that you can go and buy a treasury bond at and have a higher return on your money, you're less likely to want to go spend your money on goods and services, and you'd want to put it in there and save it and see it grow. So
Yeah.
that's one way that the Fed can try and fight inflation. And but what it also does is it brings prices down for businesses, and it puts a little bit of downward pressure there, specifically when you're talking about leverage buyouts and how private equity firms buy companies. They're
Yeah.
using debt to finance these deals. And when the interest rate goes up, you have to pay more money to borrow money. So
Yeah.
it makes it less attractive. It makes the actual cost of them doing an acquisition go up. And thus they're going to want to try and get deals at a lower price. So
Yeah.
that paired with the fact that the risk-free rate you can get on your money is higher, generally can put some downward pressure on private valuations.
Yeah, people tune in are certainly feeling the inflation, right? In their everyday lives, in their business, right? They have customers coming to them saying, I got to figure out how I can, you know, work on my costs working with you, right? There's a lot of pressure there. We all see the interest rates, housing market slowing down. So I think what would be helpful, and I know you're prepared for this, is if we walk through some examples because you said a lot there about debt leveraging, and there may be some people tuned in that know this, but even if you do, it's good to talk that through because some people may not know that, right? I have experience doing this with SaaS business, but it also affects when you're doing deals in MSPs and other, maybe small to medium businesses.
Yeah, no, I think that's a great tee up, Craig. And a lot of this stuff is what's going on behind the scenes when a private equity company is making an acquisition. And I think it's important to pull back the curtain so you see how the mechanics of this are actually playing out. So something that a firm will look at when they're doing an acquisition is what's their expected yield. And so there's two ways you can look at that. You can look at your unlevered yield, which would be if you're doing a deal without borrowing any money, and you can look at your levered yield, which is when you're using debt to help pay for part of the acquisition. What is your new yield? And so generally speaking, using debt is going to increase yield, and levered yield should be higher than unlevered yield. That's why private equity firms borrow money to help complete their acquisitions. it
Yeah.
also allows you to do a larger acquisition without having the full amount of capital available. So
Yeah.
what is yield though? So when you think about yield, it's basically cash flow divided by the cash or equity that you're putting into the transaction. So when you're calculating unlevered yield, what that would look like is EBITDA less the total purchase price, because in that example, you're not using any debt. When you are using debt and you're calculating levered yield, you're looking at your post-interest cash flow, which should be, in this case, just EBITDA less any expense you have to pay on interest, divided by the amount of equity put into the deal, which would be the total purchase price less the amount of debt that you used. So you can see in the first example here where we have a 5% interest rate that levered yield is close to 27% and unlevered yield is close to 14%. So you're getting pretty good returns on your levered yield there. But when you go to the next slide over there, where the interest rate is the only thing that's changed in this equation, it's gone from 5% to 10%. Your unlevered yield stays the
Yeah.
same because you were never using any debt before to begin with, but
Yeah.
now your levered yield goes down. And so why does it go down? Because your interest expense goes up from the interest rate increasing, and thus your post-interest cash flow goes down, and then the numerator in that equation for yield goes down, and that makes your yield go down in that ratio.
Thus, how we can see how interest rates have an effect on what companies are paying to acquire their companies and the impact on valuation. So, with that
Right.
said,
That's and maybe one more point there is that
yeah,
why does that make the private equity firm want to pay less for the business? Because that's the most actionable tool they have at their disposal to try and increase that yield back up to where it was before the interest rate increased.
right,
You're not so easily able to go to your lender and try and increase your debt multiple. And so thus you're probably going to be using the same percentage of debt and equity. And so the
yeah,
only way to bring that ratio closer to where it was before would be to reduce the denominator proportionally with the
yeah,
numerator, and that would be done by lowering the purchase price.
yeah. But I've been watching this, and you certainly firsthand doing it for years. It's not as if the valuations are like dropping off; they're just flattening out, right? It's just like we saw this major crazy run, and like oh, 4x multiple, 6, 7, 8, and like when's it gonna stop? Well, this that's going on in the macroeconomic is, like you just said, it's caused, with the example of inflation and what it's been doing on pricing of things, it's doing the same here. So to
Yeah.
continue that, let's talk about what the impact has done.
Yeah, no, I think it's a great point. We're not seeing valuations drop off, and the M&A market's still really hot. At
Yeah,
Evergreen, we're still going full steam ahead, trying to partner with businesses. And you know, interest rates aren't permanent; they're not forever. And there's also a ton of things you can do in your business to mitigate this. So
right.
whether it's going on and signing just one or two new customers, that could make up for the difference that we're seeing in interest rates. But also something you can do that's directly related to inflation is as simple as price increases. So
Yeah,
if you're seeing your costs increase, you're getting your vendors are increasing their prices because of inflation. Labor is becoming more expensive in many cases. So if you're offering high quality services, there's nothing wrong with doing some inflationary price increases. And
right.
this chart I think is actually pretty useful because you can see what the impact is if you're not doing any price increases on your revenue, but your costs are increasing 5% because of inflation. That is going to significantly impact your EBITDA. And then when you put a multiple on that for an exit and in a sale, the impact is
Yeah,
6, 7, 8x on
yeah,
that EBITDA loss.
yeah,
So the good news is that even if you're doing price increases that are equivalent to your cost increases, your revenue is a bigger pool than your costs are to begin with. So that's you're already capturing a delta just by doing that. And
yeah.
so if you're doing 5% price increases and you're having 5% cost increases in your business, you're actually probably going to drop some extra dollars to the bottom line. And again, that is impacted on a multiple when you're looking at a sale.
Right. Yeah, and one example I like to just say, which is very simple for people to understand, it's like if you have $150,000 bill with a vendor for a year and you haven't negotiated it and maybe you've sat on some of it, or maybe there's more there than you really need. If you're getting an 8x multiple and you can knock 50,000 off that, at valuation, that's $450,000 right in your pocket. It's like, it's just that simple. I think sometimes people look at it, it must be this a complicated equation that happens. It's like, no, it's actually quite simple. So yes, do love this slide. A lot of ways you can manage the business, looking at finances that people tend to forget, right? Price increases. Something like if you're doing credit card, uh, if you're charging through credit card, hit them with the surcharge on that, right? Don't eat that
Yeah.
yourself. We've seen companies get $30,000 back a year. Again, 8x multiple, $160,000. Or no, that'd be $240,000 right in your pocket. So amazing stuff. Do you have anything else to share on that, Alex?
No, Craig, I think just overall it's important to understand what's going on out there in the
Yeah,
macroeconomy. And, I think you want to arm yourself with knowledge and all the tools at your disposal so you know how to navigate these periods. But overall, I think there's still a lot of opportunity in the industry, and we're excited to continue working in it.
yeah. And speaking of valuations, if you're tuned into this and you say, okay, I get it, right? And I tell people a lot of times, you may not even be thinking about this in your business right now, but one day you're going to need to. Yes, the business is providing a salary for you and you're investing from it and you're creating jobs for people. But one day you're going to need to cash in on that. It's good to look at it now, right? We just gave examples of things you can do to drive valuation up. Why not look and see what your business is valued now so you can kind of establish a baseline, and then whatever your financial target is in your life, you can then work up from there. So Alex, I know that you do a lot of work behind the scenes on this. We have mspvaluations.com. You can go there, fill out 17 questions, not super complicated, but we need their email address, right? You can't be completely anonymous. We got to be able to get back to you. Um, so if you're tuned in, check this out. Go to the site, get it completed. Alex will be behind the scenes in the spreadsheets, putting a rough number together for you, just so you can see where you started. And hey, who knows? Maybe it might be time to take that cash, take that risk off the table for you and your business. We'd love to work with you on it. Alex, any parting words?
Yeah, no, I think you hit the nail on the head there. It can never
Okay.
hurt just to get an opinion and start preparing, even if you don't think you're going to be ready for years to come.
Yeah.
It's always better to be aligned. And I think the smoothest transactions that we've seen happen with owners are people who have been thinking about it for a while and
Yeah.
working towards a specific goal. So, any
Yeah.
way we can help with that, we want to.
All right. Okay, thanks, Alex. Appreciate you sharing the news on that. News, those of you tuned in, appreciate your time, and we'll see you next time.
Awesome.